Hi, and welcome to this course module about futures and forwards. My name is Tomas Bernholm, and I'm going to guide you through this course. The main content today is focusing on why futures and forwards. Why do investors use these products? We're going to also listen to some professionals, how they use them. We're going to see some quick facts, and we're also going to have a look at different alternatives and different instruments. And at the end, you're going to see how you can learn more, different sources to more knowledge. And the experts in the market that we are interviewing are Magnus Linder from Swedbank Robur, Lovisa Jangenstål from SEB, Marcus Pryr from Norron, and Nikos Georgelis from Atlantfonder. This doesn't mean that private investors can't benefit from trading the products. Most arguments are actually applicable also for retail clients, including day traders who can be very active in index futures in particular. To conclude, the instruments have great advantages that make them appealing to all kinds of investors.
Futures is a very good complement to our portfolio management because we can increase or decrease the risk very easily and quickly using that.
Derivatives is a way to increase the efficiency of the stock market. For example, you can with one trade, if you buy one future of OMX, then you can get the same risks as if you buy all the 30 underlying stocks by themselves. At the same time, you get lower transaction costs.
We're going to start by explaining what futures and forwards are, how they work, and provide you with some quick facts. You can say that futures and forwards are agreements that occur when trading the instruments. You get exposure directly, but the payment and delivery takes place at a later date in the future. And if you compare futures and forwards with, for instance, trading options, it's a bit different because with futures and forwards, you have the obligation to fulfill the agreement. If you have an option, you have the right and you can fulfill it if you want to. But here you have the obligation. But you can, of course, always close the position. And then if we compare futures and forwards, we can say that futures have daily settlement. This means that if it goes up and you own the future, and at the end of the day, you're going to receive some money. And if it goes down the second day, you need to pay some money. So it's always adjusted on a daily basis. But forwards have settlement on the closing day. So then you have an amount that is accumulated during the whole period. And the closing day is the expiration. In Nasdaq's Nordic market, we have index futures and stock forwards. Or I should probably say that it's most common, while there are different alternatives. And futures and forwards are Delta 1 products. If you have no leverage in them, they're moving like the underlying stock or index. Some quick facts. The price is determined based on the underlying value, let's say it's a stock, plus the interest rate, also called cost of carry, and then minus the dividend, if there is a dividend during the life cycle of the instrument. There is usually a multiplier or contract size of 100, and expiration is the third Friday in the expiration month. And when you trade futures and forwards, you need to know the codes. Futures have A to L, where A is January, B February, and so on. If we take an example, OMX S34L means that its expiration the third Friday in December 2024. Forwards have M to X, where M is January, N is February, and so on. And a similar example in Ericsson share could be that you have Eric B for the stock, 4 for 2024, X for December, and then you know its expiration the third Friday in December 2024. And now it's time to listen to some professionals in the market.
There are many advantages of trading futures. One, of course, is to handle the day-to-day business. You may have in and outflows in the fund. It's by far the most cost-efficient way to trade. It's better liquidity normally than you can find in the underlying basket. And also it's a way where you can hedge your positions. So in a stressed market condition, you can keep your core holdings and buy and sell futures on top to manage the risk. It's also a cost-efficient way to handle rebalancing in your fund. So let's say that you're moving money from US to Sweden or Sweden to Europe or something similar to that. It could also be that you're decreasing your fixed income portfolio and go up in weight in your equity portfolio. So normally what we do, you can trade the futures, so you get the exposure more or less immediately, and then over time you could sell the future and buy the specific stocks that you want to have in your core holdings.
Hi, my name is Nico Sidelis and I'm an asset manager from Atlant Fonder. We use futures primarily to increase or decrease exposure in our portfolios. They are great because they are such a sufficient way to quickly go and grab a new position or short something or hedge your portfolio. They are also really great tools for reducing the cash drag in your equity portfolios over time. You always need a bit of cash to be able to manage liquidity in your funds, and through a future you can reduce the drag that will have on your overall performance over time. Lots of times we use futures in combination with our options book. Say we have a put option to hedge your portfolio and the market has turned down and the put is really in the money, then we can just buy some futures to decrease the overall delta. Sort of, taking home the profit from the put option, and all of a sudden if you keep that combination with the futures and the put option, you have actually bought a call.
Futures can be used in various ways, both in the long equity funds, but also in the hedge funds. In the long equity funds, we can be certain that we're always fully invested. In the hedge funds, we can use futures with either selling or buying futures to reduce or increase the risk. Using futures and options, you can create a lot of good opportunities to create high risk-adjusted returns, dependent on if you have a positive view on the market or a negative view on the market. And you can also have great opportunities while the market is flat.
Something that is important for a fund is to be fully exposed over a long period of time. One reason is that since the market is going up, if you look at the 10 or 15 years of period, you can't be less invested than 100, then you will lose against your benchmark. At the same time, a fund needs to have cash on the account to handle in and outflows. So one thing that we use to be able to both be fully invested and handle in and outflows is that on top of the core holdings, so it's about 90, 95, 98% of the fund, we use futures. So by buying futures, we can have full exposure for the market and in the same time have a couple of percent of the fund in cash that we can use to handle the daily in and outflows.
So let's summarize the arguments and the benefits with futures and forwards. You can get a quick and efficient exposure, especially in an index where you have very good liquidity. The tick size is often also much smaller than the basket's tick size, so to speak. If you trade, for instance, the OMX S30 future, the tick size is 25 cent or öre. And if you trade a basket, it's usually maybe 1.5 crown. You have the possibility to go short a stock or index. You can hedge stocks or portfolios in an efficient way. You have the leverage or gearing effect. And that is because you don't have to pay for the whole asset directly. You only pay in collateral, and the collateral might be maybe 10 or 20% of the whole value, which means that you can have maybe a leverage of 5 to 10 times if you're trading futures and forwards. Cash management is a really important thing. You can be fully invested but still have cash available for other investments or handle in and outflows in a fund, for instance. You can do combinations with options, which is quite efficient. You can do spread trading, trade, for instance, one index in one country versus another in another country. And it's very easy to diversify. You can also reduce the currency risk when trading assets in other currencies. And that is because you're not paying for the asset directly. And you can also take advantage of a high stock lending rate. And that is especially for institutions, because you might have stocks and you can exchange them to forwards and futures instead. And in that way, benefit from this high stock lending rate. We have so far only been speaking about the general benefits with futures and forwards, but there are some different instruments created that also fulfills some other purposes. For instance, we have an ESG future based on our OMXS30 ESG Responsible Index. And that is very suitable for funds and other people that would like to trade ESG compliant products. Another interesting product is Nasdaq's Custom Basket Forward. You can customize an equity basket and just trade it via this forward instead, which makes it very efficient. Let's listen to what Nikos Georgidis has to say about CBFs.
For me as an active manager, Nasdaq's Custom Basket Forward offers me a really efficient way to get all the benefits from traditional futures in my fund, but still not watering down my views and my positions. I can still keep all the expressions I have in my fund 100% pure, while still getting all the benefits from traditional futures in the fund.
There are even more different products. Let's listen to Håkan Walden, Product Manager at Nasdaq.
In addition to our equity option product offering, we also have a broad coverage of different forwards and futures. On the single stock side, we offer forwards and futures with either cash settlement or physical delivery upon expiration. We also offer gross return forwards and futures. These contracts are fully adjusted for dividends paid out during the lifetime of the contract. This contract allows investors to better manage dividend risk by reflecting the performance of the stock price only. And speaking about dividend risk, there's also a specific index dividend future, where the underlying index is calculated in dividend points as the running total of the ordinary dividends paid by the index constituents. The index dividend future can either be used to hedge dividend risk or simply trade dividends on a specific market view. We offer standardized cash-settled index futures on our main equity indices in the Nordics. Please find out more on our website or contact the Nasdaq team.
If you want to learn more about derivatives, you should visit Nasdaq Derivatives Academy. There are plenty of courses there that covers more or less everything you need to know. And that was all for today. Good luck with your further learning and with your trading, of course. Thank you.